On Wall Street, the Dow dropped 37 points to finish at 34,463. The Nasdaq popped 206, and the S&P was up 30. Time now for Consumer Confidential with KTLA 5's David Lazarus.
Yep, he's here in the studio. Seeing climate change here apparently affecting now insurance.
Yeah, in a big way, too. We talked about in the 11 o'clock hour how what happened yesterday is a harsh reminder for homeowners that flooding, in other words, storms and earthquakes, not covered by the typical insurance policy. Also, keep in mind, most of the top insurers have left the California market, at least when it comes to new homeowner policies, because of the growing risk of wildfire danger. You stir all this together, and the bottom line for the insurance industry is climate change is completely upending their business, and they're not quite sure what you do about it. In fact, just a few months ago, the head of Aon, that's one of the world's largest insurance brokers, testified in Congress that climate change has basically made actuarial tables that the industry has relied on in the past completely obsolete, because he called this a crisis of confidence around the ability of predicting loss. And he's right about that, because the insurance industry isn't about paying claims, it's about managing risk. And you can't manage risk unless you can get your hands around the scope of the problem and what it's going to take to get past the problem. And the simple fact is, because of climate change, decades and decades of experience in managing risk is now moot, and the industry is searching desperately to try and find new actuarial models that will reflect the risk that the industry faces and the risk that policyholders face as well. In the time being, that means most homeowner policies are, well, a bit at risk. And if you've got something in California, obviously, if you're in any kind of fire danger area whatsoever, it's going to be a real challenge to try and get coverage. Now, Eric Anderson, the head of Aon, told Congress that the industry is working diligently to try to develop new models for pricing. But at this point, the only thing you can count on is, in a changing world with increasing risk, premiums will go up.
All right, the salary that people want in order to switch jobs has hit a record high.
Which is interesting, not a huge surprise, but in the context of fighting inflation, this is a very important point. The New York Federal Reserve is out with new stats on what's called the reservation wage, which is the amount of money that the typical job seeker is looking for to be enticed to switch jobs. And that amount is now, wait for it, almost $80,000. That's up 8% over the last year. And as Glenn noted, that's a new record high in terms of this is how much money I want to get. It really underlines the strength of the job market at a time when we were facing interest rates at a 22-year high and inflation that just doesn't want to budge. Because this upward pressure on wages, which has remained fairly consistent, also places upward pressure on consumer prices, aka inflation. And as a result, it makes it all the harder for the Federal Reserve to try to cool the economy, bring down inflation, and get us past this current situation of economic turmoil, and that's a real thing. Now, it turns out that even though the typical job hopper is looking for an $80K salary offer, the typical employer is coming in lower. According to the New York Federal Reserve, typical employer, once they've cut through all the haggling, is prepared to offer roughly $70,000 on average. However, that's nevertheless up 14% in the past year.